Okay, folks, I'm Scott Broberg, president of SBR Financial Group. Today's class, we're going to be part of our investment series, and we're going to be talking about asset classes. And this is really a foundational video that we will use to springboard into discussions about diversification, asset allocation, the nature of risk versus reward, portfolio building. If you simply jumped forward to those, we would be mentioning asset classes, and you would have to then go back and watch this to understand what exactly is an asset class and how do we set these up, what makes them different. So this is going to be one of the foundational class. So let's just start with a basic definition of an asset class. Okay, so this is going to be, they're all going to be a group of securities. So, group of securities, and or you could say investments, which, one, exhibit similar characteristics, okay? Two, and this is the one most people think about, is they behave in a similar manner in the marketplace. So on a daily basis, if your asset class is stock, they behave in a certain way that is different from an asset class of bonds. Bonds behave, they're subject to different forces, and they behave differently. They have different characteristics than stocks, but in the bond asset class, they tend to have similar characteristics. So they behave in a similar manner in the marketplace. It's one of the things that we notice a lot is people will, a more novice investor might be prone to compare apples to oranges. So they'll look at two investments and say, look, why did this one do so much better than this one last year? And the very first question I ask is, well, what's the asset class that we're talking about? Because it'll often be maybe if stocks have a negative year and commodities have a really good year, they get completely focused on the rate of return and don't even notice that it says, whatever commodity fund. Well, commodities have different characteristics than whatever stock fund they may have chosen. And the third one is that they're subject to the same laws and regulations. So they're subject to similar laws and regulations. So if I'm an entity that wants to do a bond issue, then I'm subject to certain laws and regulations that have to do with bond issues. Totally different than if I'm a company that wants to issue stock to be traded on the stock market. Stocks are governed by a different set of laws and regulations. So when we look at an asset class, you want to make sure you're comparing them to the group of securities that has all of these similarities to them. Now, as just way of introduction, we typically use two terms in this discussion of asset classes. One is traditional. So traditional asset classes are the three main ones that we're first going to talk about. So number one is cash, number two is bonds, and number three is stock. So those are the big three that we in the investment community call traditional. You also, though, have what's called alternative. And alternative isn't bad. It's just that it's different than the traditional ones that we've. So you have something about an alternative investment that will say, well, it's different, it responds differently, it behaves differently, it's subject to different laws, regulations. It may have issues of liquidity or something like that, that is different from cash, bonds, and stock. Now, in between here, and I'm just going to say this because just so that if anyone knows what some people would say in the traditional, they might throw in real estate. I do understand that real estate has moved more towards the traditional with with traded REITs, and more people have some kind of REIT showing up on their 401k. So you could have real estate that would fall somewhere in the middle here, but we're going to list it in alternative. Just know that I do know that someone could argue that it's more towards traditional. Okay, so these are the two big categories. So let's first talk about traditional. So in our traditional asset classes, okay, we have cash, we have bonds, and we have stocks. Stocks are what we call equity. So when you buy a stock, you essentially own equity in a particular company. Bonds are a form of debt. So when a company or a municipality originally, or a nation, so the United States has bonds, when they initially issue that bond, it's like they're borrowing money, and they're going to pay interest on the money that's borrowed. Once the bonds are in the marketplace, they go to the secondary bond marketplace, and then people trade those simply for the interest rate investment, or if they expect that maybe they'll even have a rise in the bond price, but most people are buying bonds for the interest rate. Okay, so these are the big three, the traditional asset classes: cash, bonds, stocks. Now I want to point out one thing, is that if we were to take a look at risk, and the measurement is really a measurement of volatility of each of these investment asset classes, that as you move this way down the line, risk goes up. So that's just how I'm laying these out. Let's go back here. So now in each of these categories, though, and I mentioned this earlier, is that you're going to end up with some kind of sub asset class category. So let me put down a few just to give you some examples of this. So if you wanted to talk cash, well, you could go put your money in your savings account at the bank, and that will pay a certain interest rate. You could also go to the bank and say, hey, I'd like to put this in a CD. And there's risk involved because the CD has a time component to it that causes the risk to change. But then because of that risk you're taking, they give you a higher interest rate. You could go to something that's called commercial paper. This would be if you ever had in a brokerage account what would be called a money market mutual fund. So it essentially trades at $1. It's supposed to. Not always. We had one that we call broke the buck, but it was because they were holding commercial paper that went bad. So commercial paper is like short-term loans between businesses. So commercial paper, and you might not be out there buying this, but a money market mutual fund might, and fairly stable, and it's got a high liquidity. Let's see, overnight loans. And again, this would probably show up more in a money market mutual fund than if you're out there trying to do this yourself. And then treasury bills. T-bills are short-term government bonds. So you could have really short, anything less than 1 year government bonds, but it's considered to be highly liquid. So these would all fall into the cash asset class. They would all have the similar characteristics. Regulations would be similar, and we would expect similar rates of return from these products. So if we move down the line then, to bonds, well, now you get, and believe me, this gets a little bit confusing. I am going to talk maybe later about this, is what's called the paradox of choice. That you look at all of these categories and subcategories, and my God, how difficult it can be when there's so many choices to make any choice at all. So we love the idea of choice up into a point where, and that's the paradox, is that choice is good until suddenly it isn't. When we're constantly in a state of regret that, hey, we chose this one when we should have chose that one. But we don't know that at the time. We only know the information that we have available to us. So bonds, we can go down bonds. Now you have U.S. Treasury notes. You have federal agency debt. These are just different subcategories of the asset class bonds. So federal agency debt. You could do mortgage bonds, right? Because a bond is a debt, is a loan. So someone makes a loan on a mortgage and then they sell that they put it into a bond and sell it off to investors. Okay, mortgage. Corporations can issue bonds. Municipalities. So, for instance, the city of San Diego can raise money. They can do a bond issue. Say if they want to fix the roads or something like that, they can do a bond issue. And then, of course, they have to pay their investors back a certain rate of interest. And the list goes on. There's 1,000 different ones on there. I'm just giving you some examples of different types of bonds. One of the things that we always consider with a bond is the agency or the issuer's risk. How do I put that? So, for instance, the U.S. government owns the printing press. So if it was going to come to defaulting, and it's always been thought that these were didn't carry any risk, is because that you can always print another dollar to pay that back. But you can't in a city, so cities don't own their printing press. So a city's risk, so the issuer's risk, is going to be one factor in the interest rate that you would demand from them. And then the second one is time. How long is this bond? If it's a very short-term bond, like 2 years, well, then your money's not at risk for very long. Or if you bought a 30-year bond, well, now you know what, boy, over 30 years, if interest rates are changing, then it changes the nature of my investment. So issuer risk and time are two of the things that we look at when it comes to bonds. Let me go down the line here and talk about stocks. So underlying stocks, we have any number of categories here that would be, you could look at, are they large, well-established companies? Are they smaller, maybe not as well-established companies? Are they international, developed? And what I mean by that is international developed would be like Europe, France, Sweden, Finland, the UK, Germany. They have developed courts of law. They have developed industrial bases. They have developed regulations. You know the regulations going into them. And they tend to be more stable than emerging markets. So emerging markets, you often run into political risk. It could be an unstable government. They could not have a very good bankruptcy system or legal system, and so the company you're investing in gets sued and you lose everything. It doesn't mean emerging markets are bad. It just means they have a different risk characteristics underneath that. So this is just any number of underlying the stocks. Okay, so we're gonna head out to finish up this video, and then we'll pick up where we are now and continue down the path to talk more about some of the alternative investments as opposed to the traditional. So you can find more and make sure you can get more information from our other videos, or you can go to our website sbrfinancialgroup.com. So we'll see you next time on the video.